Every few years, the world discovers a new financial miracle. A tiny country, we're told, has reinvented itself. A quiet backwater suddenly becomes a global financial hub. Politicians smile for cameras, journalists praise innovation. Bankers congratulate themselves for being bold enough to see what others missed. In the mid-2000s, one of the brightest miracles on Earth was Iceland, a volcanic island in the North Atlantic with a population smaller than many suburbs, a place whose wealth for most of its history came from fishing, a few aluminum smelters, and sheep. For centuries, Iceland's economy was simple, physical, and brutally tied to the sea. And yet, almost overnight, this fishing nation built a banking system whose assets were several times larger than its entire economy. Iceland, the country that used to export cod and herring, now exported credit, financial products, and swagger. Its bankers flew in private jets. Its business elite bought foreign companies, foreign football clubs, foreign real estate. Reykjavik suddenly looked less like a windswept capital and more like a miniature version of London, a fishing village running a financial empire. And then, in one brutal week in October 28, that empire collapsed. Not slowed down, not gently deflated, collapsed. 3 giant banks failed in 3 days. The national currency crashed. Foreign depositors panicked. The British government used anti-terror legislation, laws written for extremists and bomb plots, against Icelandic institutions. For a brief, surreal moment, it looked like an entire country might go bankrupt. So how does that happen? How does a small, relatively straightforward economy turn itself into a financial supernova and then evaporate? And more importantly, what does Iceland's story tell you about every miracle economy you're being sold today? This is Crash Cabinet, where money, power, and history collide, and nothing is ever as simple as it looks. Iceland 2008 wasn't just a crisis, it was a warning. To understand it, you have to start with what Iceland was before the boom. For most of its modern history, Iceland's economy could be summed up in one word: fish. The country's lifeblood was the sea, fishing rights, the size of the catch, world prices for cod and herring. These weren't abstract data points, they were the difference between prosperity and hunger. Later, Iceland added some hydropower, some geothermal energy, and a bit of heavy industry. But the core was still physical production. You pulled wealth out of the water and the ground. The financial system matched that reality. The main banks were state-owned and dull. They lent to fishermen, farmers, state enterprises, and the government. Credit was rationed. Interest rates were high. Capital controls restricted the flow of money in and out of the country. It was not glamorous. It was not cutting edge. It was functional. If you were an ambitious young Icelander in the 1970s, you didn't dream about structuring complex derivatives in London. You thought about becoming a skilled fisherman, an engineer, or maybe leaving the island entirely. Then the world changed. In the 1990s and early 2000s, a global wave of deregulation and privatization swept through developed economies. Governments were told that modern, sophisticated nations had flexible markets, liberalized capital flows, and private, profit-seeking banks. State ownership and tight controls were out of fashion. Global integration was the new religion. Iceland joined in. The state-owned banks were gradually privatized. Capital controls were loosened. The country joined the European Economic Area, gaining access to wider markets. Officials talked about modernization and competitiveness. On paper, this was Iceland stepping into the future. In reality, it was the beginning of a very dangerous experiment. Because when you take a tiny, tightly controlled banking system, you deregulate it, and then you plug it directly into the fire hose of global credit markets, you don't just get modernization, you get a speed run. 3 centuries of financial evolution compressed into about a decade. The newly privatized Icelandic banks, Glitnir, Landsbanki, and Kaupthing, did exactly what you would expect aggressive executives to do in a world drowning in cheap money. They grew. Then they grew some more. The problem was simple. Iceland itself was too small. There are only so many mortgages in a nation of a few 100,000 people, only so many fishing companies to lend to, only so many car loans and credit cards a tiny population can absorb. If the banks wanted serious profits, they had to go abroad. So they did. They tapped into European and global wholesale funding markets. They issued bonds. They borrowed in foreign currencies, euros, pounds, dollars, even yen. They set up branches and subsidiaries in the UK and across Europe. They started offering attractive online savings accounts to foreign savers who had never set foot in Iceland and never would. One of those brands, IceSave, became a symbol of the entire story. Sleek website, high interest rates, simple sign-up. To a British or Dutch depositor, it looked like any other modern online bank. You clicked, you moved your money, you saw a bigger number on the screen. Behind that screen, those deposits were being funneled into an Icelandic banking system that was quietly inflating like a balloon. By the mid-2000s, you could imagine Iceland as a small fishing boat that had somehow been hitched to 3 giant oil tankers. The country's GDP was modest, measured in single-digit billions. The bank's combined assets, however, had swollen to many times that figure. Roughly speaking, the banking system's promises to pay were around 8 to 9 times larger than the entire yearly output of the economy that was supposed to backstop them. As long as everything went perfectly, this could be sustained for a while. As long as credit was flowing, investors were happy, and nobody asked hard questions about the mismatch between the size of the banks and the size of the country, the illusion could hold. But if anything went wrong, that little boat was never going to tow those tankers to safety. Underneath the academic language and glossy annual reports, the basic strategy was old and simple. Borrow cheap, lend dear. Icelandic interest rates were high. To defend the krona and fight inflation, the central bank kept rates above those in the US or the Eurozone. That attracted carry traders, investors borrowing in low-interest currencies and moving money into Iceland to earn higher returns. At the same time, the banks themselves borrowed aggressively in foreign currencies abroad and invested those funds into higher-yielding assets. They bought foreign companies. They dabbled in real estate. They participated in global credit markets that, in the mid-2000s, seemed incapable of going down. Ordinary Icelanders were pulled into the boom, often without understanding just how fragile it was. Many households took out mortgages or car loans denominated in foreign currencies because those loans had lower interest rates. As long as the krona stayed strong, their payments were manageable, even cheap. People felt wealthier. They built new homes, upgraded cars, took foreign holidays. Reykjavik began to look like a construction site. Cranes on the skyline, new apartment blocks, new offices. This is how every financial boom feels from the inside. It doesn't feel dangerous. It feels like progress. Iceland's GDP grew quickly. Unemployment was low. Wages rose. The country's credit rating was strong. International newspapers ran glowing profiles of Iceland as a Nordic tiger. The narrative was irresistible. A once poor, isolated island had used financial innovation to leap into prosperity. But beneath the narrative, the numbers were getting worse. The bank's foreign debts exploded. Their short-term funding needs grew vast. The Central Bank of Iceland, tiny by global standards, simply did not have the balance sheet necessary to act as a true lender of last resort. If these private institutions stumbled, the state was far too small to catch them. It was like watching a village fire brigade promise to protect a skyline of skyscrapers with 2 trucks and a garden hose. They had uniforms, they had equipment, but they didn't have enough water. Then 2008 arrived, and the building caught fire. When the global financial crisis hit, the first thing to die was trust between banks. The interbank markets, where institutions lend to each other, dried up. Short-term funding, which had seemed as reliable as oxygen, suddenly became scarce. For Iceland's banks, this was fatal. They depended on rolling over vast sums of short-term debt. They owed money in foreign currencies, due regularly. The assumption was always that they could borrow new money to pay off the old. When that assumption collapsed, the entire structure shook. Investors and regulators looked more closely at Iceland and didn't like what they saw. Enormous foreign liabilities, a small domestic economy, limited foreign currency reserves, a currency, the krona, that was starting to fall. As the krona weakened, the bank's foreign currency obligations became even larger when measured in local terms. Imagine having your salary in a weak currency while your debts are locked in a strong one. Every drop in your currency is like a ratchet tightening around your finances. Outside Iceland, foreign savers started to worry. British and Dutch households, who had happily put their money into IceSave, began asking a very normal, very dangerous question. Is this actually safe? Once enough people ask that question, a bank is already in trouble. Money started to move, pressure mounted, confidence, the invisible foundation of modern finance, cracked. In late September and early October 2008, the crisis reached its breaking point. Glitnir failed. Landsbanki followed. Then Kaupthing. Within days, the 3 main pillars of Iceland's banking system collapsed. What had been marketed as a modern financial miracle was revealed as a highly leveraged bet exposed to global fear. The government faced an impossible choice. It could try to guarantee all the bank's liabilities, including foreign deposits and bonds, and sink the state alongside them. Or it could admit that the system had grown far beyond what the country could support, draw a line, and protect what it could. It chose the second path. New domestic banks were created to take over Icelandic deposits and basic local services. The old banks, stuffed with foreign debts and failing assets, were left to go through resolution and bankruptcy processes. Foreign creditors, bondholders, and many external depositors were pushed into negotiations and losses. Abroad, the reaction was swift and angry. The British government, worried about its own citizens' savings in IceSave, used anti-terror regulations to freeze Icelandic assets in the UK. In legal terms, Icelandic entities were, for a moment, treated in the same category as organizations suspected of violent extremism. For Icelanders, it was a moment of humiliation and shock. At home, the currency plunged. The cost of imported goods soared. Inflation bit into wages. Pensions and financial assets linked to the boom suffered. Households with foreign currency loans saw their debts explode in local terms. People marched in the streets. banging pots and pans outside Parliament in what became known as the kitchenware revolution. The fishing village that tried to run a global casino was being dragged back to reality. At this point, the story splits depending on who's telling it. One version says Iceland is a heroic example. The country let its banks fail instead of bailing them out at any cost. It imposed capital controls to stabilize the currency. It held some bankers and officials accountable. It endured pain, then recovered faster than others. Another version says Iceland defaulted on its obligations, left foreign creditors and savers in the lurch, and exploited its small country status to walk away from responsibilities it had willingly taken on during the boom. The truth is more complicated than either slogan. It is true that Iceland did something unusual. It drew a line between domestic and foreign obligations and refused to sacrifice its entire population on the altar of private banking mistakes. Because the banks were so much larger than the state, a full bailout would have effectively bankrupted the government and the currency together. It's also true that many ordinary Icelanders suffered severely. They were not the ones who designed complex funding structures or negotiated foreign bond issues, yet they lived with the consequences. Higher prices, higher debts, years of uncertainty, and a deep breakdown of trust between citizens and elites. Capital controls, which restricted the flow of money out of Iceland, stayed in place for years. They stabilized the situation, but also reminded everyone that the island, for a while, was financially isolated. Contracts had to be renegotiated. Foreign creditors fought for better terms. The cleanup wasn't quick, and it wasn't painless. Over time, though, Iceland did recover. Tourism boomed. People were drawn to the same dramatic landscapes that had always surrounded the island, but now came with cheap prices after the currency crash. Fisheries remained strong. New growth sectors emerged. Compared to some countries that chose to socialize enormous private losses through taxpayer-funded bailouts, Iceland's long-term economic damage looked surprisingly limited. But if you stop there, if you turn the story into a neat little tale of bold country does the right thing and wins, you miss the point. The real value of Iceland's crisis isn't in celebrating how it ended. It's in understanding how it began. Because when you look closely, you see patterns that apply far beyond one island. The first pattern is simple. Size is not safety. A financial system can grow far beyond the ability of the real economy and the state to support it. When bank balance sheets balloon to a multiple of national GDP, you have to ask who will stand behind those promises if things go wrong. Iceland in 2007, Ireland in 2008, Cyprus in 2013. Different details. Same mismatch between promises made and resources available. The second pattern, foreign money always comes with strings. When Icelandic banks raised huge sums abroad, it was easy to call it investment. It looked like global confidence in a small, dynamic country. But every euro, every pound, every dollar flowing in was also a claim on the future. Someone, somewhere, expected to be paid back, with interest. When the music stopped, those claims didn't vanish. They turned into political pressure, diplomatic standoffs, and bitter legal fights. A tiny country suddenly found itself negotiating not just with markets, but with foreign governments defending their own citizens. The third pattern. Miracles are often leverage wearing a new suit. On the surface, Iceland's growth looked like proof that ideas and innovation could overcome geography and size. But underneath, much of that miracle was just borrowed money layered on borrowed money. The same pattern appears wherever you see explosive growth built on credit expansion rather than broad, real productivity. It doesn't matter whether the story is tech, real estate, banking, or some new form of fintech. If it relies on ever-rising leverage and ever-available cheap funding, it is fragile. There is one more pattern, quieter but more personal. In every boom, there are insiders who understand the risks and outsiders who don't. In every bust, losses are not shared evenly. Some people get out early, cashing in their winnings while the music still plays. Others stay at the party until the lights come on and realize that while the drinks were free, the tab has always had their name on it. For you, sitting in a different country, maybe dealing with different institutions, Iceland 2008 can feel like a strange footnote, a quirky crisis in a remote place. It isn't. Anytime you see a small economy boasting about becoming a global financial hub in record time, you're watching a familiar script. Anytime you see banks that have assets many times larger than the country that hosts them, you're seeing the same imbalance Iceland lived through. Anytime politicians and executives tell you a new era of innovation has arrived, but cannot clearly explain who bears the downside if things go wrong, you are back on that tiny island, watching cranes rise over Reykjavik. The question isn't whether your country will become Iceland. History rarely repeats with such neat symmetry. The question is simpler and more uncomfortable. When the miracle around you starts to wobble, when the currency weakens, when the banks shrink, when the story shifts from innovation to crisis, what will you be holding? Will you be holding promises dependent on institutions that might be smaller than their own ambitions? Or will you be holding something real, assets, skills, resilience, that can survive the moment when faith in the system breaks. Iceland's banks tried to turn a fishing village into a global casino and discovered, the hard way, that the house doesn't always win. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.